Good evening to all the participants of the WhiteOak Quarterly Connect. One of the key questions that comes across when people talk about valuation is, the India premium, that India always trades at significant premium to emerging markets. And that's a question that's often cited by a lot of foreign investors, including Indian investors who talk about valuations of the Indian market. And we will try to explain our views on why India market trades at valuation, at these kind of valuations. So first, does growth explain valuations? Often the single most reason cited is, India is the fastest growing economy in the world, so it ought to trade at the very high valuation. Now, if you compare over the last 20 years, India with China, China's real GDP growth at 9% has been higher than India. Yet, Indian equity markets have delivered better returns than China over the last 20 years. And despite China's significantly higher growth, China has constantly traded at significant discount to the Indian market. So we clearly know high growth is not what explains the valuation premium for India. If you think about any country or any sector, it's not often the fastest growing company in a sector or a country that, whether on revenues or profits, that has the highest multiple. There are other key factors that matter that determine valuations. And those factors, in our opinion, are corporate governance and the quality of underlying assets. And these two come from WhiteOak's fundamental framework for identifying great businesses, which is businesses which generate superior returns on incremental capital, that is quality of underlying assets, scalable long-term opportunity, which is about growth. And we know that factor alone does not explain the valuations of companies also, and governance. And can we use this same framework to understand countries and their valuations? So when you think of a market, the market valuation, the market cap of a country is nothing but the sum of the values of all the listed companies in the country, which is nothing but the present value of future cash flows of all the listed companies in that country. So as minority investors, all of us have a proportionate right to the cash flows of a company when we invest in shares of a company. So when we know the corporate governance is weak, then as investors, minorities investors' rights can be violated or badly treated by controlling shareholders. And the argument that we have a proportionate right to to the proportionate cash flows of the company may not be true. And that is why whenever a company has a problem around corporate governance, those companies tend to trade at discount to the market and the better governed companies. And the weaker the corporate governance is, the higher the discount a company trades. Similarly, let's assume if you own shares in a country, if the country has property rights which are strong and well protected, and in the sense that nobody can easily challenge those property rights, including the authorities. And even if such a challenge happens, you have a fair recourse in the court to get a fair protection of your rights. In those jurisdictions, your rights will be more valuable and the shares of those geographies would be more valuable. That is why property rights is one of the most important element of determining the market multiple of a company, whether as a country you have strong property rights or not. What drives strong property rights? Fundamentally, it is about having institutions which protect property rights. Typically, strong democracies tend to have independent institutions like, when you think of a democracy, a typical democracy has three arms of the government: your legislature, executive, and judiciary. And these three institutions kind of balance out each other. And democracies, as in the process of evolution, build credible institutions to protect the key tenets of a democracy. So you have judiciary, you have central bank and election commission. They're fundamentally very strong institutions that occur in a democracy. Because of the separation of powers of these entities, whenever any of them, when any of the three arms of the government breach the authority, the other arms come to balance the property, the rights of the other arms. That's why you have strong property rights in democracies. And that is a very important element of why democracies are a lot more valuable for investors. Now, if you look at in India, there's a rating by BTI, which looks at separation of powers across all emerging markets. India is highly rated on this framework, one of the highest rated countries on the separation of powers. Unlike a lot of autocracies at the bottom, where there is no distinction between what is the executive, who's the prosecutor, and who's the judge. While India, all the three arms of the government are separate. And these elements translate in, go back to this, this is collectively called the soft infrastructure of a country. Think of hard infrastructure as the roads, ports, and logistics infrastructure, while this is the soft infrastructure. And why is this valuable? And let me give you an example. In 2004, I took a road trip from Bombay to Rajasthan. And at that time, our roads were getting just better at that. The quadrilateral project had started. And there was a short patch of road between Ahmedabad and Mehsana, which was an excellent road. And I said, when as a country, we will have these roads? And a decade later, now we have these kind of roads in large parts of the country. And as we speak today, we are building from Bombay to Delhi, the world's largest expressway. So a country, if determined in a 5 to 10 year period, can build the hard infrastructure. We ourselves from 2005 to 15 have gone from power deficit to power surplus country. However, building soft infrastructure, these institutions, is the work of many generations. For example, one of the assets any country has is educated people. To educate just a generation of people, you need 25 years. And soft infrastructure is about getting many generations right into these tenets. And that is why a quality soft infrastructure is a lot more valuable than quality hard infrastructure. And that's why investors are willing to pay up for quality soft infrastructure versus quality hard infrastructure. And the soft infrastructure, for example, of India has also ensured that in the last many decades, India didn't have either a currency crisis or a debt crisis or a political crisis or a coup, which is a feature of a lot of emerging markets, a common recurring theme across a lot of emerging markets. And whenever these things happen, first your asset quality gets damaged, and even your property rights can get damaged when these events happen. And because of this non-recurrence of these debacles in India, India's risk premium is lower. And that is one of the reasons Indian market trades at a premium to other emerging markets. India also has one of the most, among emerging markets, one of the most mature democracies. When you often go to some of the East Asian countries and you look at the infrastructure, let's say in China, and you say, oh, wow, this is luxury. But when the world looks at India on soft infrastructure, they say this is wow, this is a luxury, because it's harder to achieve soft infrastructure than to achieve hard infrastructure. And India, despite being an emerging market, in many of our features of our democratic regime, whether an independent judiciary, central bank, and election commission, is actually comparable to some of the Western developed democracies of the world. And that is one of the reasons why India trades at multiple. We all know, and I've talked about the fact that how democracies are better protecting property rights. And that is why when you compare P multiples of democratic countries versus the least democratic countries, the countries, better governed democracies tend to trade at premium to the least governed democracies. And that is one key explanation of the India's valuation multiple. The other thing that drives valuation multiple, apart from just earnings, is the quality of assets. And we all know that the profits of a commodity company will get a very different multiple versus, let's say, a dominant consumer staples company, because the sustainability of those profits and cash flows are very different. So a country that has very different assets have to trade at very different multiple from the country with very inferior assets. One large determiner of the asset mix in a country is just the share of ownership of state-owned entities, what we call PSUs in the country, as a share of the market. And why we have seen all over the world that PSUs trade at large discount to their private peers and constantly lose market share over long term in every industry. And that is why, and why do PSUs struggle? Simply because the focus of PSUs is not to maximize shareholder returns, which is the objective of private companies. For PSUs, social and political objectives are a lot more important and achieve greater priority over investor interest. And even if a PSU has large assets, they can be ad hoc appropriated to serve the objectives of the government at any point of time and to the detriment of minority investors. When you compare India on this metric, at emerging markets level, state PSU ownership is 19% average. Countries like China, Russia are much higher level than the EM average. And of course, any country that has a large share of these inferior assets ought to trade at a much lower multiple than the average. India's share of the PSUs is only 6% of the market cap, which is 1/3 the average of just the EMs. And that is also one big reason why Indian market trades, because we don't have those inferior assets in our mix. Other element, and we have seen from experience now, that consistently, private companies trade at higher multiple to government-owned companies. And as investors have got mature and thought more about governance in the emerging markets, that multiple between private sector and PSUs have only got expanded. And that's why the mix of PSUs and private companies in any market is a determiner of aggregate multiples. Finally, when you think about the Indian market, and often I see people compare P multiples of India without thinking hard about what lies within the Indian index. It's like to blindly compare the multiples of two companies without thinking hard about the quality of assets of those companies. Indian market has the most heterogeneous composition by sectors and by companies versus any of the major emerging markets. When you look at some of the sectoral compositions of some of the emerging markets, if you look at Taiwan, 69% comes from technology hardware. If you look at, and 37% of that is single company called TCMC, which is one of the world's largest semiconductor companies. Korea, 41% comes from technology, and Samsung Group accounts for 39% of the market cap of Korea. Russia, 45 plus 15, 60% comes from commodity industry. While in India, all major sectors have fair representation and there is no overdependence on it. In fact, the largest sector India has financials, and we all know some of the best banks in the world come from India. HDFC Bank has been consistently rated the best bank in Asia. So our asset mix is far superior. Even at an individual company level, Indian market is the most heterogeneous. And for that, we are using the Herfindahl index, which is a measure of market concentration in any market. The lower the number, the least the concentration of companies or in the market. India, among all the major emerging markets, has the least company concentration. Number two feature you'll observe here in the slide is number of these countries are dependent on large sectors, which are very deeply cyclical or commodity-like. For example, Russia with large dependence on commodities, Korea and Taiwan with dependence on technology, hardware, and other countries with dependence on metals and minings. They tend to be deeply cyclical sectors, while India has very limited exposure. Even in technology, Our entire technology is IT services and software, which is a very different business than tech IT hardware. And that is also one of the reasons then whenever downturns happen, in economies globally, Indian market earnings are the most resilient across all major emerging markets. Just across every year, Indian earnings have been through difficult down cycles, you know, have been the most resilient across emerging markets. And we have seen this applies at the company level, right? Companies who perform extremely well during downturns are the ones which deserve high multiple. So to think about now valuations, often this explanation of just the difference in growth does not explain India's premium multiple. But I think the key factors that are often underappreciated by investors is the role of corporate governance at a country level, where India is far superior to large number of emerging markets, and the high quality of companies and sectors that exist in the Indian market. We of course believe there are other factors that impact these multiples, and we'll be happy to hear from you. However, anyone who just cursory makes a headline comparison of P multiples across various markets, in our opinion, is trying to compare apples with oranges or apples with lemons. I hope we are able to bring different perspective on explain the reason why Indian market trades at multiple to emerging markets. Thank you.